You are listening to ChartingWealth.com's weekly review and forecast for the week beginning Monday, the 1st of February, 2016. Thank you so much for being with us. Here's what we do in our weekly review. First thing we do is we go through our three indexes, which is the total market, the S&P 500, and the NASDAQ 100. We look at gold, and we look at all four of these charts on both the weekly and the daily. It's the only time, the rest of the time we're looking throughout the course of the week, every day the market's open, the 2-day and the half-day, for good reasons that we explain in multiple videos at the site. But what we like to do once a week is take a much bigger picture. It's also the only time that we pay attention to the news. That is what happened this last week and what's on tap for potentially affecting the markets over the course of the new week. Why do we do that? Because we pay attention to the charts and not the noise. We don't want to get caught up in what the talking heads are saying in the media. We want to pay attention to what's really going on in the markets. But it does behoove us every now and then, that is once a week, to look back and see what affected the market and then what events could be affecting it in the coming week. That's why we have this broadcast, and we do it every Sunday to prepare. Sometimes we do it on Fridays at the close of the market, but usually on Sunday after we've digested everything, and we get it ready for you so that you can hear it Sunday or Monday morning and be ready for the new week that is upon us. Let's jump right into things. We're jumping in first to IYY. What is that? Well, it's the iShares Dow Jones U.S. Total Market Index Fund, an exchange-traded fund, tracks the whole stock market. What's going on overall? Well, the market crossed over on the weekly chart going down on our MACD and on the candles. And the MACD is the moving average convergence divergence. It's the real indicator that we use all the time. The derivative oscillator is another one that we get some hints from, but we don't really count on it a lot. What we do pay attention to is when the derivative oscillator and the MACD cross in the same direction at the same time. That can be quite helpful. The derivative oscillator actually crossed a week ahead going down of the MACD when the total market went down around the end of the year, the 31st, going into the first week. And what we see happening is the market has gone down 3 weeks, the week ending January 8, January 15, January 22, and then leveled out with a little green up candle, pretty much a spinning top is what we can call that candlestick pattern as the week itself ended on the 29th of January. Now, we don't have any kind of crossover going up. It looks like the derivative oscillator lost a little bit of its downward momentum, but still in a confirmed down move on the big chart. Now, if we revert back and go look at the daily chart, we can see what happened throughout the course of the week. The week began on the 25th, a red open down candle, then a green up candle on the 26th, and then lots of indecisions, what we're seeing with two dojis pretty much over the next 2 days. That's Wednesday and Thursday. And then Friday, the market decided that it would move up some. Now, in no way has it recovered much at all after this huge down move that started on the 4th of January. But we do have a crossover going up on the daily chart on the 26th. So on the shorter chart, the daily chart, which is of course a fifth the size of the 5-day weekly chart, we do have an up move. But again, overall market is down. If there's enough of an up move, of course, it'll drag, the daily chart will drag the weekly in its direction. Then we wait for a pullback on the daily and for it to turn back over and give us a safe place to look at jumping in and riding up those gains if indeed the market does that, which it may or may not do. We don't know. We just simply read the charts, take our piece of the pie, however big or small it might be, and we want to minimize our risks and maximize our profits. Isn't that what you're supposed to do? Buy low, sell high. That's what we want to do. That's what we're looking to do. That's what makes us potentially more powerful than professional traders who have to trade. We don't. We can look for the good times when the markets are telling us just what they're about to do. That's when we want to train ourselves to be able to get into the market. So that's where we are on IYY. Let's go to our next. We're going to range back out to our weekly chart, and we're going to go to SPY. And SPY is the Standard & Poor's 500. It crossed over going down again right at the end of the year on the weekly chart. 3 big down weeks, and then sort of a spinning top week for the week that just ended on the 29th of January. And that's, again, somewhat similar to what we saw in the total market with the SPY, which is, of course, a lot of the volume, the S&P 500, a lot of the volume of the big market, the total market. If we range out to our daily chart, we can see how the week transpired. And again, it started off on the 25th, and what we see is a bit of an open red box, some up movement on Tuesday, some sliding sideways on Wednesday and Thursday, and then some big up movement on Friday, a crossover going up on the 26th. And that is where our daily chart is. Again, in an up move, overall weekly chart on the Standard & Poor's 500 in a down move. Now let's go to the Qs, and we'll revert back to our weekly chart. See where that is. The Qs, the NASDAQ 100 crossed over going down again, like all the charts did on the 31st, and it moved down for 3 full weeks, and more of an up move on the NASDAQ 100 than we saw in the S&P 500. And what we have happening is, again, confirmed down moves, derivative oscillator, lit up just a little bit higher in its down moves than it had the week prior. But again, we're just continuing to see down movement. The MACD has not rolled back at all. It doesn't appear. That's the moving average convergence divergence. If we drop back to our daily chart, see what we see. We, of course, see a week that opened with some down moves, slid sideways and down a little bit on Wednesday and Thursday, and then up move on Friday. Just so you know, total market was up on Friday 2.34%. The NASDAQ 100 was up 2.09 and the S&P 500 2.44. Nice gains on Friday, but that is where the markets are at this point. Still confirmed down moves on the big chart, that is the weekly chart, and an up move starting on the 25th. Not a strong surging up move at this point, but an up move. We've gone ahead on our 2-day charts for our daily charts, and we've redrawn our trend lines to show that up move. It's not much of an up move. It's not an accelerated up move, but we'll continue to watch it. We still don't have any confirmed up moves on either our 2-day or our weekly chart. So if this is the dead cat bounce that it could be and it rolls back over on the short charts, we'll sure pay attention to that and jump into hopefully some good momentum going down in inverse funds, like with the Qs, QID. It's a double inverse. So when the Qs goes down, QID goes up. If you know anything about trading, about investing, we want you to make sure you go ahead and open yourself up a virtual trading account so that you can start trading. That's what we're all about. We're not a stock calling service. We're here to teach you. We've got videos on the website, chartingwealth.com, and we love to have you follow us every day. Pay attention to what we talk about. Start charting things. Start seeing how predictive you can be, how accurate you can be in your predictions, and then start buying and selling virtually. You can set up a virtual trading account at any of these online brokerage firms. They'll be happy to help you set that up for free. You can do it online yourself, become a virtual millionaire, and then start trading and seeing how good you are at this stuff. And once you get good, make up your own mind, and at some point, you might start trading your own money. Now, let's lastly go and look at GLD, and we're going to revert back to our weekly chart. GLD is, of course, gold. It tracks gold at 10% of gold's value. And what do we see going? Well, gold moved over on the weekly chart the week ending the 8th of January, and it has continued to move up over 4 weeks. Lots of gains in gold over the week ending the 29th of January. Gold on Friday was up 0.38% along with the market's gains. Now, if we drop back, so gold's a confirmed up move on the weekly chart. If we drop back, and that was after bottoming out, way low. I mean, the lowest low for gold in several years, as I recall. Now, if we go to our daily chart, what do we see happening over the course of the week? Well, on the 25th, gold actually started surging up again after sliding sideways the prior week, Wednesday, Thursday, and Friday. On the week ending the 22nd, when the week opened on the 25th, gold started moving up substantially Monday, Tuesday, and Wednesday, and then just sort of slid sideways Thursday and Friday as the market itself started gaining steam. That is the stock market. And again, gold can be a hedge sometimes. It can move inverse, usually does, to the market. If the market's gaining steam, gold tends to move down. And as the market surged on Friday, gold just sort of slid sideways. It's technically up 0.38%. So continue to watch. Of course, our 4-hour chart on our daily reviews has been working better since January started. So continue to pay attention, watch our daily programming, and we'll give you more and more about what's happening on a daily basis with gold. That is where we are as far as the markets went. Now let's quickly jump into the news. For the week that ended on the 29th of January, we see a number of things happen. U.S. growth has slowed for the fourth quarter. The Federal Reserve has held its rates steady, leaving open the option for further rate hikes. Let's see what happens. It depends on how slow the economy goes. The Bank of Japan has adopted a negative interest rate policy. Isn't that interesting? They're not just at zero now. They're going into the negative. The ECB's, that's the European Central Bank's chief, Drago, takes his critics to task, going after them. And the Russian economy is contracting significantly because of the low prices of oil. And as we jump into things, we do see that the Bank of Japan, on a vote of 4-5, their policymakers have actually adopted a negative rate policy on funds above certain set thresholds that are deposited with the central bank. That is an interesting way to do things. And this news came out on the heels of Friday's announcement that the Japanese inflation rate came in well below the targets in 2015. It only rose 0.5%. And the Bank of Japan had a negative interest rate policy in place, of course, for zero interest rate policy in place for many years. What about the U.S. economy? Well, our economy has only grown at a very modest, a very low 0.7% interest rate, okay? That's just a 0.7, not 7, 0.7% interest rate annual in the fourth quarter. This ends up reflecting the impact of a number of things: tepid global demand, inventory gluts, the U.S. dollar being extremely strong. Growth has slowed from 2% pace in the third quarter, again to a 0.7% pace. The full year gross domestic product rose 2.4%, and that was the same growth that we had in 2014. Now we start looking at the Fed. They have left the interest rate unchanged for January, and the outlook for further interest rates looks very uncertain. The market liked the fact that they did not increase the interest rates, or at least it didn't cause any huge tremors. It's what was expected. The Russian economy, as we said, has contracted significantly in 2015. Oil prices literally hit them like a hammer, knocking almost 4% off the size of their economy. Can you imagine that? It's 4% just bam from the interest rates. From the oil prices being so low. Retail sales down a full 15+%. Industrial production down 4.5%. That is a hammer. But there's hope. Why? Because OPEC is talking about cutting its production. And if that happens, of course, when you have less supply and the same and or growing demand, supply versus demand, you don't have supply, you have demand, prices go up as long as demand stays the same or increases and supply decreases. Now, as we jump into things as to what's happening over the course of this next week, we're going to see on Monday, ECB, that's European Central Bank President Drago, is going to appear before the European Parliament, talk to them. We'll see what he has to say about things. Will that affect the markets substantially? Probably not, unless he says something really crazy, which is not expected. It's not what central bank presidents do. Manufacturing Purchasers Index is going to be released on Monday also. We're going to hear from Stanley Fischer, who's the Fed Vice Chair. He's going to speak in New York on Monday also. So we'll see what he has to say and how that affects things. The Reserve Bank of Australia is going to meet and set their interest rates on Tuesday. Global Services Sector PMI is going to be released on Wednesday. The Bank of England Their Monetary Policy Committee is going to meet on Thursday. Again, you could hear something. And the U.S. employment report is going to be set for release on Friday, the 5th. So, not a whole lot of stuff. A couple of these things could move the markets, but probably not too much. Not like we're having a major Fed meeting and Yellen's coming out saying anything that could really rile the market. So, we'll continue to watch and see. It's important to continue to see how earnings season pans out. So far, earnings have been okay. And again, don't forget, earnings ought to be okay because companies, of course, cautiously set their own earnings. So if you can't hit your own mark, you're in a big world of hurt. So as we continue to see, as earnings season continues to shift around, it's in full swing right now. And so far, about 73% of companies reporting in the S&P 500 index have beaten their expectations. 47% or so of companies have beaten revenue forecasts. So, according to Zacks Investment Research, that's not too bad. So, as long as there's nothing that really pounds the market, we'll see how things continue to shake out. Hope that this weekly review and forecast has been helpful for you. We always love to hear from you. You can follow us at chartingwealth.com. We like you to go there every day. You can get our newsletter. That is our weekly review and forecast every Sunday night, so you can get it on Sunday night or Monday morning. Also, we do our daily reviews every single day. We send those out to you. If you sign up for our newsletter at the website, chartingwealth.com, you will get those in your email. You'll also get two nice bonuses. That is our layout our layout from chartingwealth.com at freestockcharts.com. The operative word there is free. The best stock charts in the world, I think. In addition to that, you'll also get our video, How to Read a Stock Chart. You'll get the link to that. All that stuff comes for free. And so please sign up at the website. Follow us on Facebook, Twitter, Instagram, YouTube, you name it. We are there for you. Thank you so much for listening to us from chartingwealth.com.